What is crypto's next insane move, pump or dump? Just a couple of days ago, we saw massive sell-offs happen in the market. How can we foresee these price fluctuations and not ape in at all-time highs? In this video, we'll look at how to read the market and understand price cycles. We'll look at the latest news and updates for crypto and where the market is right now in terms of demand and if it's tailing off into a bear market or not. Plus what some people think about the current state of crypto and potential future prices. Quickly though, I have 20% off the crypto investor course in November, then the price goes up. Over 100 videos about crypto and investing and private Discord groups. Future content will be added for free for existing course members. Just look for the discount code on moneyzg.academy or link in description. Firstly, how can we understand if the market is overheated and ready to be sold off? On-chain analysis can tell us pretty much everything we need to know and even more. If you don't want to go and do the analytics yourself, Twitter is a great place to start with some dedicated accounts that will show us concrete supply and demand characteristics. If you want to prevent yourself aping in at the top and seeing your position in a loss, like we got with a healthy drawdown from all-time highs this week, here's how to do it. Firstly, we can look at futures funding to see how overheated the market is. Go to coinglass.com, which recently rebranded from Bybit or ByBT, and see how much people are paying to go long Bitcoin. If funding rates are high, it means that a lot of people are going long, as demand for funding, just like anything else, pushes the price up. CoinGlass and other sites also show that funding rates were quite high over the last few weeks, meaning lots of traders were all going long. Like has happened many times before with Bitcoin, those traders will over leverage and the market will get too hot with the potential to suffer a liquidation event where selling pressure comes in, longs start to get liquidated and then over leveraged traders get pushed out of their positions. If funding rates are very high, it probably means the price is going through a breakout phase or reaching new highs. So just be aware that there may be a dump to bring the market to a more healthy state without too much leverage. Also check out a site like KuCoin where funding rates are very, very indicative of long interest. If USDT lending rates are above 15 to 20%, inching into 30 or more percent, we are massively in a bull phase that may see some choppy drawdowns from highs. Next, we can come to exchange inflows, which show us how much Bitcoin, if any, is being deposited onto exchanges. If someone is putting Bitcoin onto an exchange from a wallet, we can be 99% certain that they want to sell it. Otherwise, why would they put it on the exchange? An increase of inflows to exchanges possibly means dumping from individual wallets, but what we can see by the data is currently inflows are flat to negative and the data showing all exchange reserves shows historically low amounts of Bitcoin on exchanges to trade. Fundamentally, this means fewer people are wanting to sell Bitcoin right now, so keep an eye on this metric to see how this changes over time. Next, we can look at something called MVRV. MVRV shows us the difference between the price right now, so the open market price as it stands, and the average price that people have paid for Bitcoin over time. Basically, it tells us if the current market price is really high compared to what people have paid for their Bitcoin in the past. This could show us if the price is near a top, when people will just start selling out for their big profits. And we can also compare it to previous cycles, which right now, as you can see, it shows us there's no clear indication whatsoever of an overheated market. We're definitely towards the higher end, but not very high compared to historic highs. Remember that, as I just pointed out earlier, the higher the MVRV ratio, the more likely it is that token holders or coin holders will start to exit their positions and look to lock in their profits. In the current scenario that we're looking at, BTC holders may yet hold on to their position and still go long over time in anticipation of yet another bull run, given the strong fundamentals of not only BTC but crypto itself, pushing MVRV to historically very high levels, which would definitely be more indicative of maybe a top that people would sell into. Lastly, we can look at SOPR. This indicator provides insight into macro market sentiment with profitability and losses taken over a particular time frame. Essentially, how much is someone selling for compared to what they paid? Are they taking profits or not? And yes, they did take profits at 67 and 69K that we got to last week. Short-term traders took profits at those highs, but the market is settling again at this current level. So then if you want to keep an eye on when the market is overheated, look for leverage, and specifically too much leverage to the upside, and also some profit taking. Both of these may result in a sell-off. MVRV, SOPR, and futures funding rates will tell you all of that and maybe prevent you from aping in with FOMO in all-time high territory. Plan B also recently tweeted that he thinks 98,000 for Bitcoin is still in play for November and 135,000 for December. Hopium, maybe. I can't see it myself, but I would love to be incorrect, and I hope he is correct. So what do I do to prepare for big moves in crypto prices, and how do I play this? Well, I very simply use dollar cost averaging over time to get a long-term average price for BTC and other cryptos that's basically going to be the same as the market's average price. A simple way would be to buy the same amount of crypto each week for a year or for much longer than that. And that way you'd never buy too much at all-time highs. You'd get some crypto at cheaper prices as well when these sell-offs occur. Dollar cost averaging has downsides. For example, the price may rise a lot, meaning you just have to consistently pay higher prices over time. That's not really the point though. If we assume Bitcoin and crypto will grow, then just participating in that growth is enough. And we can understand that the market will always have cycles and sell-offs and times when it's reaching new highs. Considering that most of us don't have the entire amount of our complete lifetime wealth to invest at one time, dollar cost averaging just means that you'll get a normal average price for your cryptocurrency and participate in the growth of the market over time without aping in at highs, getting scared when there are 10% drawdowns and things like that. Compounding your positions is also a fantastic and overlooked way to grow your bags over time. If we also assume that crypto prices over the long term are going to grow, then we can use compounding. I found it a much more beneficial way than trying to time the market, trade in and out, and basically increase your risk factor by high multiples. If you hold a proof of stake crypto, you may want to stake that on the blockchain to get some passive income and compound your holdings. If you hold Bitcoin, consider using a platform like Celsius Wallet or BlockFi to get a 4 to 6% yield on your Bitcoin over time. We can see from this very simple compound interest calculation that if you've got a $10,000 investment that goes up 5% per year over 6 years, you'll make a good return. But earning interest on it and compounding your investment will significantly grow your investment higher than if you didn't do that. Around 25% more gains over the same period. This of course assumes that the asset will go up, which is down to uncertainty of course. If you want to check out Celsius or BlockFi, I do have deposit bonuses linked in the description. $50 of BTC with your first deposit on Celsius and up to $250 on BlockFi, and they will pay you daily interest and compound that over time. I think crypto will continue to see adoption on a wider global scale. I think that's pretty obvious by now. In a general sense, as the networks grow and the market grows, the value of the coin should also grow over time, but obviously this is down to high fluctuations. As a general example of widespread adoption, just this month, the Houston Rockets franchise will actually get paid for a sponsorship by New York Digital Investment Group in Bitcoin. NYDIG is going to become the team's official Bitcoin services partner and platform, and as part of the partnership, NYDIG is planning to name some of the Rockets' premium seating at the Toyota Center in Houston the Bitcoin Suites. We've also seen that Crypto.com will spend $700 million to rename the Staples Center the Crypto.com Arena. So crypto isn't going anywhere, and it's going to have ups and downs, but if you think that in general the market will grow, then dollar cost averaging, compounding your interests, doing all that boring stuff is probably the best long-term solution versus aping into Dogecoin or just trying to trade the market that we really don't know where prices are going to be next month or tomorrow. Moving on to Ethereum though, and generally with ETH, the fundamentals look very solid as well, even given recent price falls from those all-time highs. Burned ETH after EIP 1559 is continuing and will not stop. EIP 1559 won't stop burning ETH and taking it out of circulation as the network grows. We also see the daily chart for transactions and active addresses which are high and growing, showing an uptrend since August of this year. Raoul Pal, in a recent Twitter post, also tweeted that he expects a 100 to 300% rally in Ethereum by the end of this year, and he sees that after such a huge rally, there's still a strong possibility that prices may even go higher than that. Notably, he had previously said that the supply squeeze will be a price catalyst due to ETH being tied up in the ETH 2.0 contract and also EIP 1559 taking away ETH from the market. Anyway, I'm not sure if I'm that bullish. It just seems so outlandish to think that Ethereum can double or more by the end of the year. But I am also extremely prepared to be wrong. I hope I am. And let's see if he is right. ETH-based holdings, though, amongst institutions are also up around 20% in the third quarter of this year. Recently, 10 new firms disclosed that they had ETH in their investment portfolios. The two largest were Tocqueville Asset Management with around 80,000 shares of the Grayscale ETH Trust, and Main Management with around 78,000 shares. We know this and we've seen this before, and it just shows how crypto is becoming an investable asset class for institutions. Yes, it's still smaller, and yes, it's still called their alternative investments, but that's quite a big change from them not even touching cryptocurrencies as little as a year ago, and the trend is extremely clear. Ethereum is a strong base asset for DeFi. Bitcoin is becoming a base asset for traditional finance, but Ethereum is increasingly becoming a strong asset to be used for collateralization of loans and other investments in decentralized finance. This is thanks to EIP 1559, making it hard money with very low inflation, if any, and scaling solutions out there, which will see increased adoption and use of the network, which typically results in higher valuations for the base coin, which in this example is Ethereum. An example of how scaling solutions can help Ethereum is with the case of Unstoppable Domains, which is transitioning its domain names, which are NFTs, to Polygon, which is built on top of ETH, or more as a kind of side chain really, as a way of increasing transaction speeds and lowering costs. Another fundamental stat to look at is development activity. If we understand that cryptocurrencies are networks of people that create value, over the long term, we would possibly want to concentrate on networks with the most activity, as we would presume that those networks will have the most products and services that attract users, and users bring value in many different ways. This report from Outlier Ventures came out in September this year and shows that Ethereum is the most actively developed blockchain, followed by Cardano, with Bitcoin actually in third. I probably wouldn't underestimate the importance of fundamental development data like this. We recently suffered a 10% correction from all-time highs for Bitcoin. Prices, in my opinion, are noise and not the signal. If you DCA into good projects with development, that in my opinion would be a less risky way to get into crypto, by participating over the long term in projects that have the best chance of success, given that they have the most amount of people building products and services on them. Of course, as projects mature, we may see that development slows and the most amount of activity will be in newer chains that are in those early stages and need a lot of development and work. Ethereum, though, had nearly 50,000 commits during the time period, Cardano with almost 40,000, and Bitcoin with around 20,000. If you want to make some longer term investment decisions based on fundamental data, this might be something to look at, and I'll leave the report link in the description for you. Crypto adoption doesn't seem like it's stopping anytime soon, but there will be, for the foreseeable future, many downturns and crazy pumps and dumps to the price. Although there are ways to reduce this risk and also not get caught aping in at 70,000 Bitcoin all-time highs. If you want to know more about how I invest and trade crypto, I've got 20% off the Crypto Investor course in November with over 100 videos about crypto and investing. Enter code HODL over at moneyzg.academy or link in description. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.